If you thought silver was done making headlines, you weren't paying attention. Last night, silver didn't just move. Silver detonated. We're not talking about a calm grind higher. We're not talking about a normal risk-on session where metals drift up with equities. We're talking about a vertical explosion that made the chart look like someone drew it with a broken ruler. Silver ripped 7.3% in a single session, punching through the psychological $100 barrier like it was cardboard, and closing above $103 with momentum that made even the bulls nervous. And when a metal moves like that, when it skips steps on the staircase instead of climbing them, you don't throw a party first. You investigate first, because that's how you avoid becoming exit liquidity for someone who planned this move before you even woke up. It's Tuesday morning, and the time in New York is 4:15 a.m. I'm recording this before the sun comes up because what happened overnight matters more than whatever headline you're going to see at breakfast. Comment below what time you're watching this because I'm genuinely curious how many of you are tracking these moves in real time versus catching up later. The answer tells me something about this community. I'm John, and before we dive deep into what just happened and what it means for your money, I need to address something that's been bothering me. YouTube analytics show me the truth. A massive percentage of people watching these videos, getting value from them, learning mechanics that most financial media won't teach you, still haven't subscribed. If you've watched more than 2 of my videos and you're still not subscribed, I need you to fix that right now. It takes 1 second, it costs you nothing. And it helps this channel reach more people who need to understand what's really happening in these markets. Hit subscribe, hit the notification bell, and let's build something here. Now let's talk about what actually happened because the sequence matters more than the headline. Silver opened the session looking normal. It had that familiar drift, the kind of price action that doesn't make anyone's heart rate change. Buyers were present but not aggressive. Sellers were offering but not panicking. It looked like another consolidation day where the market digests previous gains and waits for a catalyst. Then something shifted. Around the European close, the tone changed. The bids started stacking. The offers started thinning. And price began accelerating in a way that told you this wasn't just organic buying. This was pressure being released. The kind of pressure that builds when too many people are positioned on one side of the boat, and someone suddenly yells that the boat is tipping. What followed was not a rally. It was an upward crash. I use that term deliberately because it captures something most people miss. We're trained to think of crashes as downward events. Violent, scary, destructive moves lower. But the mechanics of a crash can work in both directions. When shorts get squeezed, when option dealers are forced to hedge, when liquidity disappears from the offer side, price can explode upward with the same violence and chaos that we normally associate with collapses, and that's exactly what happened. Let me unpack the options mechanics because this is where the real leverage lives. When silver started moving, it crossed strike prices where significant call option open interest was sitting. Those calls were probably sold by dealers who hedge their exposure dynamically. As price rises and those calls move from out of the money toward in the money, dealers have to buy more of the underlying to stay hedged. But here's the feedback loop that turns a move into a monster. Their buying pushes price higher. Higher price means more hedging required. More hedging means more buying. And suddenly you've got a mechanical spiral that feeds on itself until it exhausts. This is gamma. This is convexity. This is the hidden engine behind moves that look impossible on a chart. And silver, because of its relatively small market size compared to gold or major currencies, is especially vulnerable to these dynamics. It doesn't take an ocean of capital to move silver when the order book gets thin. A few large players hitting the same direction at the same time can create moves that look like the market broke. And last night, it looked like the market broke upward. Now, I want you to understand something crucial before we go further. I'm not here to tell you that silver is going to $200 by Friday. I'm not here to tell you that the dollar is collapsing tomorrow. I'm not here to feed you hopium or doom. I'm here to help you understand the mechanics so you can make your own decisions with clear eyes. The opportunity in silver right now is real, but the trap is real too. And the difference between capturing the opportunity and falling into the trap is whether you understand what's driving the move and whether you have a plan that survives volatility. Because make no mistake, volatility is here. When a metal moves 7.3% in a single session, that's not calm price discovery. That's a market under stress. And stressed markets don't care about your feelings. They don't care about your cost basis. They don't care about what you think silver should be worth. They move based on flows, positioning, and mechanics. And if you're not aligned with those forces, you get run over. Here's what I'm going to do in this video. First, I'm going to break down the paper versus physical divergence because this is where the real story lives. The quote you see on a screen is not necessarily the price you can transact at in the real world, and that gap is screaming right now. Second, I'm going to show you the supply and demand data that's driving this move at a structural level, because this isn't just about speculation. There's a fundamental supply deficit story that most people still don't understand. Third, I'm going to give you practical guidance on what to consider if you're trading paper products holding physical metal, or looking at mining stocks. And finally, I'm going to share what I'm personally watching as signals for what comes next. This is going to be dense. This is going to be detailed. And this is going to be the kind of content that helps you whether the market goes up another 20% or pulls back 15% first. So stay with me. Now let's get into the part of this story that makes everyday people furious once they understand it, the paper price versus the physical reality. Because you can pull up any financial website right now and see silver quoted at $103 and change. That number is real in the sense that it reflects where futures contracts are trading on major exchanges. But if you try to act on that number in the physical world, you're going to discover something uncomfortable. The price you see is not the price you get. It's not even close. And this gap, this divergence between paper and physical, is one of the most important signals in the entire precious metals market. When the gap is small, it means the market is functioning smoothly. Supply chains are clear, dealers are confident, arbitrage is keeping everything aligned. But when the gap blows out, when premiums explode and spreads widen, it means something is breaking down behind the scenes. And right now, something is breaking down. Let me paint you a picture of what's actually happening on the ground. I've been talking to dealers. I've been monitoring online inventory. I've been tracking what real people are experiencing when they try to buy or sell silver in the current environment. And the reports are consistent across the board. Chaos. If you want to buy silver right now, depending on what product you want and where you're located, you might be paying $10, $15, even $20 over the spot price for popular coins and bars. Some dealers are completely out of certain products. Others have inventory, but they're rationing it to established customers. Others are quoting delivery times of weeks instead of days. This is not normal. In a calm market, premiums on standard bullion products might be $2 to $4 over spot. Right now, those premiums have tripled or quadrupled depending on what you're trying to buy. That premium is a tax. It's the price of access. And when access becomes expensive, it tells you that the supply chain is under stress. Now let's flip it around. What if you're trying to sell? This is where it gets even more interesting. You might assume that if premiums are high for buyers, sellers should be getting great prices too. But that's not how it works when the system is stressed. Dealers are quoting all over the map for buybacks. Some are paying spot or slightly above for certain products because they need inventory and they're willing to compete. But others are paying significantly under spot, especially for products that require processing, assaying, or that don't fit their current demand profile. Why would a dealer pay under spot when silver just ripped to 103? Because that dealer's cash is tied up. Because their refining partners are backlogged. Because they're nervous about holding inventory in a market that just moved 7% in one direction and could move 7% in the other direction tomorrow. Dealers live and die by inventory turns and cash flow. When volatility spikes, every decision becomes a bet, and many dealers protect themselves by widening spreads on both sides. They charge more to sell to you. They pay less to buy from you. The spread is their insurance policy against getting caught on the wrong side of a move. Let me explain the refining bottleneck because this is a piece of the puzzle most people never think about. When price spikes, behavior changes. People who've been sitting on silver for years suddenly decide to sell. Maybe they need cash. Maybe they think it's the top. Maybe they just want to lock in gains. Whatever the reason, metal starts flowing toward dealers and refiners. But not all silver is equal. Some of it is pure bullion in recognized forms that can be resold immediately. But a lot of it is odd bars, old coins, jewelry, scrap, and mixed purity material that needs to be processed before it can re-enter the market. Refiners have limited capacity. When volume spikes, they get backed up. And when refiners get backed up, they become selective. They prioritize material that's easy to process. They deprioritize material that requires extra steps. This creates a situation where not all silver can reach the market, even if sellers want to sell it. And that creates tightness that shows up as premiums for the products that are actually available and ready to trade. Now let me add another layer of complexity, the international dimension. Silver doesn't trade in one unified global market. It trades in multiple markets with connections between them. New York has COMEX futures. London has the LBMA over-the-counter market. Shanghai has its own exchange with its own contracts and its own inventory. In theory, arbitrage should keep these markets aligned. If silver is cheap in one place and expensive in another, traders should buy where it's cheap, ship the metal, and sell where it's expensive, pocketing the difference and bringing prices back together. In practice, this arbitrage is much messier than it sounds. There are different contract specifications. There are approved bar lists and purity requirements. There are shipping costs and insurance. There are financing costs that spike when volatility rises. There are customs procedures and local taxes. And there are delivery windows that don't always line up. So when you see the Shanghai silver price trading at a significant premium to the New York price, which is exactly what's happening right now, you can't just assume that traders will instantly close the gap. The gap can persist for days, weeks, or even longer when the friction is high enough. What does this premium tell us? It tells us that in at least one major market, buyers are willing to pay more for silver than the global benchmark suggests. It tells us that the pipes between markets are narrower than headlines imply. It tells us that the metal might be in the wrong form in the wrong place, or that the usual middlemen don't want to take the risk of bridging the gap. And it tells us that the world is not treating silver as one homogeneous commodity. It's treating silver as a collection of separate pools with gates between them. And when those gates get sticky, prices diverge. This is why I keep telling you not to be hypnotized by the screen price. The screen price is a reference point, not a guarantee. The real price of silver is whatever price you can actually transact at, in the quantity you want, in the form you need, in the location where you are. And right now, that real price is significantly different from the paper quote depending on your circumstances. Here's my blunt advice for anyone dealing with physical metal right now. This is not the time to panic buy or panic sell. When spreads blow out like this, you're paying a volatility tax every time you transact. You're handing money to the spread and calling it a trade. If you already own physical metal that you bought for long-term protection, you don't need to do anything special because of one wild session. Your metal is doing what it's supposed to do. It's sitting there, holding value, outside the financial system. And if you don't own physical and you're suddenly feeling the urge to chase after a vertical candle, I need you to pump the brakes. Chasing into chaos means paying maximum premium for minimum certainty. It means becoming exit liquidity for someone who planned ahead. Wait for the dust to settle. Wait for spreads to normalize. Let the premium panic cool down. The market will still be there in a week. Now let's go deeper into the mechanics, because understanding why this happened is more valuable than knowing that it happened. Silver didn't move 7.3% because of one piece of news. Silver moved 7.3% because of accumulated pressure that finally found release. And when you understand where that pressure came from, you can start to anticipate where it might go next. Let me walk you through the pressure points one by one. Pressure point number one is positioning. Silver has always attracted aggressive short sellers because it's volatile and because a significant portion of its demand is industrial rather than monetary. In calm markets, shorts can lean on silver with relative confidence. They know that industrial demand is somewhat price sensitive, that above-ground inventories exist, and that the market has historically rewarded patience on the short side after parabolic moves. But in fast markets, shorts get hunted. When price starts running and doesn't stop, every short position becomes a potential forced buyer. Stops get triggered. Margin calls arrive. Brokers demand more collateral or start liquidating positions, and what started as a trade becomes a scramble. This scramble is not orderly selling of the short position. It's desperate buying to cover, often at whatever price the market offers. And that buying adds fuel to the rally, pushing price higher, triggering more stops, forcing more covering, creating a feedback loop of mechanical violence. Pressure point number two is the options market, and I touched on this earlier, but let me go deeper. Options are not just bets on direction. They're instruments that create hedging obligations for the dealers who sell them. When you buy a call option, you're betting that price goes up. The dealer who sold you that call is now exposed. If silver rockets higher, that dealer owes you the difference. To protect themselves, dealers hedge. They buy futures or physical metal in proportion to their exposure. This proportion, called delta, changes as price moves. When silver was at $95 and you held a $105 call, that call had a low delta. The dealer only needed a small hedge. But as silver approaches $105, the delta increases. The call becomes more likely to finish in the money, so the dealer needs more hedge. And if silver blows through $105 and keeps going, the dealer is scrambling to buy more silver to stay hedged. This is gamma exposure. And in a market with significant call open interest clustered around certain strikes, a rally can trigger cascading hedging flows that accelerate the move far beyond what fundamental buyers alone would create. Now here's the part that should make you cautious. The same mechanics that drive price up can slam it down when the forced buying exhausts. Once the shorts have covered, they're done. Once the option dealers are fully hedged, they're done. Once the momentum chasers have bought, they're done. And then the market looks around and asks, who's the next buyer? If the answer is nobody with size and urgency, price can reverse sharply. This is why I call these moves upward crashes. They feel like crashes because they're driven by mechanics rather than patience. And mechanical moves tend to be followed by mechanical hangovers. The rally doesn't slowly give back gains. It can collapse quickly as the same dynamics work in reverse. Dealers start selling their hedges as price falls, longs who bought the top panic. Stops get triggered on the downside, and suddenly the people who felt like geniuses at the highs are underwater at the lows. Pressure point number three is liquidity, or more precisely, the lack of it at key moments. Silver is not a small market, but it's not a large market either compared to gold, currencies, or major equity indices. The order book can get thin, especially during off hours or when volatility is elevated. And when the order book is thin, it doesn't take massive size to move price. A few large players hitting the same direction at the same time can create moves that look disproportionate to the actual dollar flow. This is why silver can feel broken even when it's technically functioning. It's not that the market is rigged, it's that the market is small enough that large players have outsized impact. And when those large players are all leaning the same way because of shared positioning, shared hedging obligations, or shared reactions to the same catalysts, the move becomes amplified. Pressure point number 4 is the gold correlation. Gold has been on a tear. It recently punched above $5,000 for the first time ever, setting record after record as money flows into hard assets. When gold moves like that, it changes the narrative around the entire precious metals complex. People who never think about silver suddenly become interested. They see gold hitting all-time highs and they look for a cheaper alternative that might offer more upside. Silver becomes that alternative in their minds. It's not a perfect way to think about the metals. Gold is primarily monetary, while silver is split between monetary and industrial, but it is how a lot of money behaves. And when that money starts flowing into silver on top of the other pressure points we discussed, you get moves like what we just saw. Pressure point number 5 is the macro backdrop. Why is gold at all-time highs in the first place? Because the market is pricing in a mix of currency weakness, policy uncertainty, fiscal concerns, and geopolitical risk. Central banks around the world have been accumulating gold for years, diversifying away from dollar-denominated assets. Investment flows into gold funds have been accelerating, and the general sense in markets is that the old playbook, the one where you could trust currencies and bonds to preserve purchasing power, is breaking down. In that environment, hard assets get bid, gold gets bid, and silver gets dragged along for the ride, often with more volatility because of its smaller size and its industrial component. So when you zoom out, the 7.3% move in silver isn't random. It's the product of accumulated pressure across multiple dimensions, all releasing at once. Short covering, options, hedging, thin liquidity, gold leadership, macro fear. Each of these alone can move silver. All of them together create explosions. Now here's what I want you to internalize. These mechanics work both ways. Every pressure point I just described can reverse. Shorts can reload once the squeeze is done. Options can expire or get closed. Liquidity can return on the offer side. Gold can pause or correct. Macro sentiment can shift. And when those reversals happen, the same speed and violence that drove price up can drive price down. This is why trading silver is not for the faint of heart. This is why people who don't understand the mechanics get destroyed even when they're right about the long-term direction. You can be fundamentally correct that silver is going higher over time and still get wiped out by a 20% pullback that you didn't have the position size or the mental framework to survive. The market doesn't care that you were early. The market only cares about price and time. And if your timing is wrong and your sizing is reckless, being right eventually doesn't matter. Now let's shift from mechanics to fundamentals, because this is where the long-term story lives. The move we just saw wasn't pure speculation. It wasn't just traders gambling with leverage. There's a structural supply and demand picture underneath this market that has been building for years. And that picture is one of the most compelling in any commodity market right now. Let me break it down for you. On the demand side, silver is experiencing something unprecedented. It's being pulled by two completely different forces at the same time. On one hand, you have investment demand. People buying silver as a store of value, as an inflation hedge, as protection against currency debasement, and as an alternative to financial assets they no longer trust. This demand is unpredictable. It surges when fear increases and retreats when confidence returns. On the other hand, you have industrial demand, and this is where the story has fundamentally changed over the past decade. Silver is not just a precious metal, it's a critical industrial input. And the industries that need it are not optional. They're the backbone of the energy transition and the technology economy. Let's talk about solar. The solar industry has become a monster consumer of silver. Photovoltaic cells use silver paste for conductivity, and as the world installs more solar capacity every year, silver demand from this sector has been growing at double-digit percentages. Based on publicly available industry data, solar silver demand is now running in the range of 200 million ounces per year and climbing. Some forecasts suggest it could hit 300 million ounces or more within a few years as installation rates accelerate. And this isn't speculation. The panels are being installed, the projects are being built, the orders are being placed. This is real demand hitting the market in real time. And unlike investment demand, which can disappear overnight when sentiment changes, industrial demand is sticky. Factories don't shut down because silver went up 7%. They grumble about costs, they try to engineer around the problem, but ultimately they buy what they need, because they can't deliver their products without it. Now add electronics. Silver is used in everything from smartphones to automobiles to medical devices. It's used for contacts, switches, connectors, and anywhere that conductivity and reliability matter. The amounts per device are small, but multiply those small amounts by billions of devices, and you get significant demand. Add electrification of vehicles. Electric cars and hybrids use more silver than traditional internal combustion vehicles. Estimates vary, but the range is typically between 1 and 2 ounces per vehicle, sometimes more for high-end models with advanced electronics. Multiply that by tens of millions of EVs being produced annually, and you can see the demand trajectory. Add data centers and AI infrastructure. This is the new frontier of silver demand that almost nobody talks about. High-performance computing requires high-performance connections. Silver shows up in specialized applications where copper isn't good enough and where reliability is critical. As AI data centers expand, as power distribution becomes more complex, silver finds its way into the architecture. So when you add up all the industrial demand categories, solar plus electronics plus vehicles plus infrastructure plus everything else, you get a baseline demand that is fundamentally different from what silver experienced in previous cycles. This is not a market waiting for speculators to show up. This is a market being pulled by real consumption from industries that are growing. And investment demand, when it arrives, stacks on top of that industrial baseline. That's the demand picture. Now let's talk about supply. Supply is where the story gets uncomfortable. Silver mine production has been essentially flat for years. The most recent annual figures put global mine output around 820 to 850 million ounces, depending on whose numbers you use. That's not growing. In some years, it's actually declining slightly. Why? Because silver is a strange commodity in terms of how it's produced. The majority of silver comes as a byproduct of mining other metals, primarily lead, zinc, copper, and gold. Only a minority comes from primary silver mines where silver is the main product. This means that silver supply doesn't respond directly to silver prices the way you might expect. If silver doubles, mining companies don't suddenly produce twice as much silver. They might increase primary silver mine output somewhat, but the byproduct supply is driven by decisions about those other metals. And if lead and zinc prices are weak, some of those mines cut production regardless of what silver is doing. This creates inelastic supply. Prices can scream higher, but supply doesn't respond quickly. On top of that, new mining projects take years to develop. You can't just decide to produce more silver and have it appear next month. Exploration takes time, permitting takes time, financing takes time, construction takes time, ramping up production takes time. In a world where environmental regulations are tightening and where capital markets are cautious about funding new commodity projects, the pipeline of new supply is thin, so you have demand growing, especially from industrial sectors that can't easily substitute away from silver, and you have supply that's flat to declining with no quick fix on the horizon. What happens when demand exceeds supply year after year? Deficits. The market has been running deficits for multiple years now, not small deficits. Substantial deficits measured in tens of millions of ounces annually. How do deficits get funded? By drawing down inventory. Somewhere in the world, there's a stock of silver sitting in vaults, in warehouses, in various forms that has been accumulated over decades. That inventory is the buffer. It's what allows the market to function even when current production doesn't meet current demand. But here's the thing about inventory. It's not infinite. Every year that demand exceeds supply, some of that inventory gets consumed. And the data is showing that this is happening. COMEX warehouse inventories have fallen sharply from their peaks. Total registered and eligible silver on the exchange has dropped by over 100 million ounces from the highs seen in recent years. This matters because it's visible, it's tracked, it's reported. And when the market sees inventory falling, it starts to worry about what happens when the buffer runs out. This is the fundamental backdrop that makes me take the current move seriously. It's not just mechanical. It's not just technical. There's a real supply squeeze building underneath the surface. And when you combine that fundamental tightness with the mechanical triggers we discussed earlier, you get the potential for moves that surprise everyone. Silver's ability to go parabolic is well documented historically. It did it in the late 1970s. It did it in 2011. It's done it in smaller bursts many times. And each time, the common thread was a combination of investment demand surging on top of structural tightness. Are we there now? I don't know. But I know that the ingredients are present. Now let's get practical because I know that's what you really want. Given everything we've discussed, what should you actually do? How should you position yourself in this environment? I'm going to break this down by category because the right answer depends on who you are and what you're trying to accomplish. If you're a long-term physical holder, someone who bought silver months or years ago as insurance against financial instability, your job right now is simple. Do nothing dramatic. Your metal is doing exactly what it's supposed to do. It's holding value outside the financial system. It's appreciating as confidence in paper assets erodes. You don't need to sell into this chaos unless you have a specific need for cash. And you don't need to buy more at panic premiums unless you're genuinely underallocated and willing to pay up for access. The volatility on the screen doesn't change the fundamental reason you own physical metal. The reason was never to time the market perfectly. The reason was to have something real when the system gets weird. Well, the system is getting weird. Your metal is doing its job. Let it work. If you're looking to add physical metal and you haven't yet, here's my honest advice. Wait for premiums to normalize. Right now, you're competing with panic buyers. Dealers are stressed. Supply chains are backed up. Premiums are elevated. Every dollar you pay in premium is a dollar that doesn't go toward actual silver. In a week or two, when the volatility settles, premiums will compress. Dealer inventory will stabilize. You'll get more metal for the same money. I know that's not the exciting answer. I know you want to act right now because the price is moving and you're afraid of missing out. But chasing vertical candles is how people get hurt. The market will still be there when the dust settles, and you'll have a much better entry if you're patient. If you're trading paper products, futures, large liquid ETFs, options, you're playing a different game. The paper market gives you clean execution, tight spreads, and the ability to move quickly. It also gives you full exposure to the volatility. In a market like this, $5 moves can happen while you're in the shower. $10 moves can happen while you're sleeping. If you're going to play this game, you need discipline. You need defined risk on every position. You need to know what you'll do if you're wrong before the market tells you you're wrong. And you need position sizing that allows you to survive being wrong multiple times without blowing up. The traders who get destroyed in markets like this are the ones who size too big, chase too late, and have no plan for when the music stops. Don't be that trader. For paper trades, I'm personally watching key levels that I won't mention precisely because they'll change by the time you watch this, but the principle is the same. I want to see whether pullbacks find buyers or whether they cascade into liquidation. I want to see whether new highs get defended or rejected. I want to see volume patterns that tell me if the move has institutional conviction or if it's just retail excitement. These signals inform my decisions. They should inform yours too. Don't trade based on hope. Trade based on price action and predefined rules. Now let's talk about miners, because this is the lane that offers the most torque if you get it right. Mining stocks are not the same as owning metal. They're businesses. They have operational risks, cost structures, balance sheets, and management teams. They can underperform even when metal prices rise if their costs spike, their projects disappoint, or their financing is toxic. But when a quality miner is positioned in a rising price environment, the leverage can be extraordinary. Here's the simple math. A miner's profitability doesn't depend on revenue. It depends on margin. If silver sells at $60 and it costs $40 to produce, the margin is $20. If silver sells at $100, the margin becomes $60. That's a 3 times increase in margin from a 67% increase in price. That's torque. And that's why quality producers can see their stocks re-rate dramatically in an environment like this. But here's where people get hurt. They buy anything with silver in the name. Some companies are real producers generating cash. Some are developers who are years away from production. Some are explorers who own interesting dirt but have no near-term revenue. And some are just stories, stock promotion vehicles that rise when silver is hot and collapse when silver cools. In a hot tape, everything goes up. The quality names go up. The garbage goes up. Sometimes the garbage goes up more because it's trading like a lottery ticket. But when the tape cools, the garbage collapses first and hardest. You don't want to be holding garbage when that happens. So if you're looking at miners, do the work. Ask whether the company is producing today. Ask whether they're generating positive operating cash flow or burning money. Ask whether their balance sheet is clean or loaded with debt. Ask whether their all-in sustaining costs are competitive or marginal. Ask whether management has a track record of execution or a track record of excuses. Ask whether the stock has been diluted into oblivion or whether share count is stable. These questions are boring. They're unsexy. They require reading financial statements instead of watching YouTube videos. But they're the difference between making money and giving money away. Now, here's my final message before we wrap this up. What happened in silver last night is not the end of the story. It's a chapter. Maybe it's the beginning of a much larger move. Maybe it's a blow-off that gets retraced quickly. I don't know which one. Nobody knows which one, and anyone who tells you they know is selling confidence, not analysis. What I do know is that the fundamental supply and demand picture is real. The industrial demand growth is real, the supply constraints are real, the inventory declines are real, the premiums in the physical market are real. These are not memes, they're data. And data suggests that silver is in a structural deficit that isn't getting fixed quickly. That doesn't mean you should bet recklessly. It means you should be prepared for a range of outcomes. Prepare for more upside that makes today's move look like a warm-up. Prepare for a vicious pullback that shakes out weak hands. Prepare for choppy consolidation that tests everyone's patience. The common thread across all those scenarios is discipline. If you have physical, hold it with conviction. If you're trading paper, trade with rules. If you're buying miners, buy quality and avoid garbage. Do those things and you'll be in a position to benefit from wherever this goes. Drop a comment below telling me what you're seeing in your local market. Are premiums insane? Are dealers out of stock? Are buyback offers weird? That ground-level intelligence helps everyone in this community stay realistic about what's actually happening. Also, tell me which lane you're in. Are you focused on physical, paper, or miners? What's your strategy? I read these comments. They inform what I cover next. If you got value from this video, subscribe right now, hit the notification bell so you don't miss the next update, and share this with someone who needs to understand what's really happening in silver. The more people who understand the mechanics, the fewer people get hurt when the volatility arrives. Thanks for watching, stay disciplined, and I'll see you in the next one.